Markets around the world are up, but a less than stellar midday bond auction sent stocks lower. But why is this important? Today, we discuss that and earnings. Elon has fumbled the bag for a second quarter in a row, and it seems the pain for Tesla investors is not over, with weak guidance flagged for 2024. So as the S&P 500 touched 4,900 for the first time in intraday trade, let's break out the stats to see what that means for the year ahead. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell. Let's get into it. It was all about technology, but not the entire sector. It was really just like semiconductors, manufacturers, and a couple of banks. That was really all the index put out in terms of gains. Everything else was pretty red. Comms did all right. Google, Meta, pretty good days. Netflix up 10% on their earnings, and then energy here, but it doesn't have much weight in the S&P 500 as a whole. But we saw selling in defensives, rate sensitive sectors, utilities, real estate, industrials, even though they've been on quite the tear in the last week. They're up like 3% in total, down significantly today. Tesla had their earnings call, and yeah, we're going to talk about everything in the show today, guys. But let's quickly talk about breadth. Very weak breadth. We had 357 losers in the S&P 500, 141 gainers, and it was really just held up by, big companies and semiconductors, technology, as well as financials, and those tend to be the bigger companies, and that's why we were ever so slightly positive on the day. We pretty much call it flat. Now, looking at the majors as a whole, again, look at what performed. The Nasdaq, again, big tech names, Microsoft, Nvidia, Google, Meta. That's why we were up on the day. S&P 500 was flat. Small caps again gave a lot back. So too did bonds. We're going to talk about that later. But what you guys want to realize is right here, 1 p.m., everything just went downhill. We were actually trending really, really well. I mean, not so much small caps and bonds. The S&P 500 was up, so too was the Nasdaq. And at 1 p.m., everything went down. And this had to do with the 5-year bond auction at 1 p.m. Now, let's actually talk about it. So bonds rose significantly, particularly the 10-year and the longer duration bonds. And that's because the 5-year bond auction was not pretty. It was tailed by 2 basis points, 2 whole basis points. Normally, you'd see a tail of like 0.3 basis points or 0.4 basis points. This was 2 basis points. It was not good. It sent yields higher. And it just goes to show that there's still that uncertainty in the bond market. And this is really what you want to watch, because the credit market is the biggest and most liquid market in the world. Bonds don't follow stocks. Stocks follow bonds. And that's exactly what we saw today. Bond auction was terrible and stocks moved lower as a result. Looking at sectors, now have a look at what were the worst performing sectors on the day. Home builders, real estate, gold. So if rates go up, cash is more attractive, gold's going to go down. Same with home builders and real estate. And then the top performing sectors, semiconductors, 1.7% on the day. Same with energy after what went on in the Red Sea. And then now regional banks were the outliers, but a ton of regional banks reporting next week. We have SoFi on Monday, and I think that regional banks are sort of like running up into their earnings. Other than that, bonds were the big story of today, even though we didn't take the major headlines. Another reason why bonds were pushing up higher is because the Federal Reserve came out and said that the BTFP, the Bank Term Funding Program, which was pretty much the backstop preventing the SVB crisis from escalating, they're going to cease to make new loans on the 11th of March. My birthday, by the way, guys. Wish me on that day. So on that day, on the 11th of March, the Bank Term Funding Program is going to stop. There'll be no more BTFP. This could be a real issue for liquidity looking ahead into the market. However, I do believe that the Fed is probably going to come out and replace it with something else in terms of shore up liquidity. And if they do need liquidity, they'll set up a program like this very, very quickly. Now, what did that do for rates? And yesterday we were looking at just a 53% chance of keeping it the same. Today it's 58.8% and only a 40% chance of a 500 to 525 basis point Fed fund rate. Now, what we're actually seeing right here is that May is the most likely outcome for a rate cut, which is, 5 months away right now. And then right after May, in close second, is December. So this is why these rate sensitive sectors have really been pulling back. We saw real estate, we saw home builders pull back, we've seen gold pull back significantly, and this is the reason why. Now, let's for a second assume we're 6 months and 12 months away from a rate cut. What do yields normally do in that time? And normally what happens is that 12 months out, and 6 months out yields before the actual Fed cuts rates tends to rally even more. And if we are 12 months away from a potential rate cut, we could see yields go higher, and we're looking at probably 1% higher. That's 100 basis points. So we could actually see the 10-year, which is right now at 4.1, go back up to like the 5% level. That's not going to bode well for mid caps and these rate sensitive names. And I think that's why we're seeing the mega caps outperform, because the market is sort of trying to price in what's going to happen with rates, what's going to happen with the inflation front. And this is why we're seeing again that very thin leadership at the top, like we saw today. Breadth not that great. The big caps holding up the entire index. However, when the Fed does initially cut rates, equities do rally, yields do fall, especially if we don't get a recession. Now, let's talk about earnings, guys. And we had another big dog. Yesterday was Netflix. Great earnings. We covered them. ASML reported earnings. Really good. Orders were surging for ASL. I think IBM were up in after hours. Same with ServiceNow. No, ServiceNow were down 0.5%. I think the Lam Research came in line with earnings. I haven't looked at Seagate. They're in the semiconductor memory space. I want to check on their earnings. SAP beat earnings. They were up 8% in after hours. But the big one we all want to talk about is Tesla. These were the earnings for Tesla. And I'm going to be honest with you guys, no matter which way you spin this, I don't think the report was that good. I've seen some people say it wasn't as bad as you could expect, but it was bad. I mean, they missed on revenue. They missed on EPS. They missed on gross margins. And I mean, Elon on the earnings call said some very weird things. They're looking at their Dojo supercomputer, which was going to like rival NVIDIA in terms of processing capacity. And that's how they were going to move away from NVIDIA. And Elon came out and said it was a long shot. He made some jokes about institutional ownership. The earnings call was not good. The earnings call was not good at all. And earnings was not good at all. I mean, this is particularly margins. I mean, margins did increase. So the street was expecting this, but the margins did actually tick up compared to last quarter. Margins actually did tick up compared to last quarter. But looking at the income statement for Q4 for Tesla, and we could see they put out $20.6 billion in auto sales revenue, total revenue of $25.2 billion. Tesla's energy business, however, was really, really good. It was on the up and up, and this was the highlight of their earnings report. But all in all, they put out $25.2 billion in revenue, 4.4 in gross profit, and 18% margin, or 17.1, an operating profit of 8% margin, and then a net profit of 7.9 billion. And a lot of this came because of a tax benefit of 5.5 billion. The cost of revenue was $20.7 billion. And all in all, these were their operating expenses. So it wasn't a good earnings call for Tesla. It was down 5% in after hours. And one thing that the market didn't like was that Elon flagged that sales could be weaker throughout 2024. So in other words, margin compression, pricing power, competition is heating up, and it wasn't a good earnings report at all. A triple miss and terrible guidance. Other data we got today, PMI's data, and I just wanted to show you this chart really, really quick first. So this is the global industry growth heat map, and you can see that manufacturing PMIs throughout 2023 for pretty much everybody across the board, except for some emerging markets right here, has been in negative territory. I mean, particularly here in the Eurozone, not so much in America, Canada, Australia, Japan, but in Europe in particularly, where manufacturing is heavily relied on. It has been in the dumps, as well as a couple of companies, Czech Republic, Russia, Indonesia, some bright spots of green like India. All in all, manufacturing PMIs have been on the decline. But we are starting to see that turn around, because we got the PMIs data yesterday. Manufacturing ticked up, still in contraction. Services ticked up too, and the overall composite, the combination of the two, finally saw an increase above the 50 level, which is expansion territory. Now, looking at the euro area, very similar situation. We're seeing PMIs bottom in the euro area, and composite PMIs as a whole for Europe just above 50 right there. This euro area is the gray line. And all in all, American PMIs look to be bottoming out and improving the Eurozone as well. And if we actually have a look at forward-looking indicators, they are positive in January, but there is renewed supply chain pressures. But with what's happening in the Red Sea, there could definitely be some supply chain pressures that do occur, and some weak data we might see in PMIs over the next couple of months. Along with that, we saw the geopolitical risk index increase 6% this week. week, but we're still yet to see what this means as a whole for the global supply chain. Keeping with the theme of the global supply chain, the Hang Seng Index put up another positive day, 3.5% after yesterday's 2.3% rally. So the index looks like it's starting to form a bottom, although I do want to see more strength before I even consider this. But the China stimulus deal, the market seems to like it. There's also been a lot of like insider buying in Tencent and Alibaba, and the market tends to like this. And maybe China has finally bottomed. Maybe this is the bottom of China, but there's no need to rush into this right now. China is down 76% from their highs, and I would wait for more strength in the tape before even thinking about taking a position in something like the Hang Seng Index. Goldman do believe that China over the next year will see returns on a bull case of about 33%, a base case of about 18%, and the absolutely worst case, a 4% increase in the MSCI China Index, although it will come with a lot of volatility. But if you are looking for international equity exposure, you can have a look at these. Now, this is quant rated ETFs by Seeking Alpha, and the DXJ, the Wisdom Tree Japan Hedged Equity Fund, came in at number 1. But generally speaking, all of these tend to be very good international ETFs. A lot of them are Japan, but there is some India ETFs. Argentina's there as well. VanEck India Growth Leaders. So you could get some real outsized returns, especially in these emerging market sectors. You know, they're looking at growing their economy like 7% for the next 5 years. Kind of crazy when you think about it. Now, looking at overall growth in the US and not internationally, the Magnificent 7 is looking at consensus sales growth compounded over the next 2 to 3 years of 11%. The S&P 500 as a whole is looking at 3%. Now, looking at small caps, according to BofA, the relative multiple of small caps where they are right now suggests that they could outperform large caps over the next 10 years, and they could outperform large cap by about 4% every single year. If the S&P 500 is to return 10%, you're looking at small cap returns of about 14% annually. Crazy when you think about that. And this is also true for the absolute forward PE for the Russell 2000s. It suggests double-digit annualized 10-year returns, and we're looking at anywhere in the spectrum from 10 to 14% annualized returns for the Russell 2000. Now, let's talk seasonality. This right here is the S&P 500 seasonal performance for February. I thought I'd give you guys the inside scoop. I haven't put it on Twitter yet. February tends to be negative in total return, but we do see quite a positive month up until the first half, and then from there we kind of sell towards the end of February into March. Some more interesting stats I thought I'd bring to your attention. This is when we've had a pre-election year of 20% or more, and generally what follows. And in every single situation where we've had a pre-election year 20% plus, we've never ever had a negative election year, 100% of the time higher. Average return in the election year, 11.3%, 100% of the time higher. So, you know, stats are on the side of the bulls. For the most part, that's what's happened in January. I mean, the first week and a half of January, there was a bit of a hiccup. But other than that, January is up like 3.1% in the S&P 500 so far, and that's a very bullish month, all things considered. Here's some more stats, and according to Oppenheimer, they believe that the S&P 500 is conservatively undervalued below 5,400, and that's kind of crazy. So I'm guessing they're saying their fair value is at 5,400. So they said the S&P 500 has gained 73% during the median bull cycle. If we only look at the 11 shortest and most muted cycles of the 23 total, the median gain drops to 62%. S&P 5,400 would equate to a 51% bottom to top rise. In addition, we found out that 16 of the 23 bull cycles, 70% lasted into their 2-year anniversary. So they've sort of like built a margin in safety by looking at the 11 shortest and most muted cycles, and they saw an average return of 51%. Where are we right now? 31%, and that leaves us with about average gains left in the market of 20% to get to their fair value. Now, let's talk about gamma, guys. Not much to say. We're still in fairly positive gamma, and we are going to see a lot more gamma come into the tape as we leave this window of weakness. 4,900 continues to be the core gamma resistance, and that's exactly where we are right now. We sort of in positive gamma, we buy dips, sell rips, and make our way towards this 4,900 area. Strong resistance did come. We sort of bounced off this 4,900 area intraday, and that's generally what we see almost always. The same was true when we had the core gamma resistance at 4800, 4700, 4600. Go plot these points on your chart and have a look at them. Every time we get there, we see strong rejections because this is where dealer gamma hedging is strongest. If we do get above this level and we do come down, we're going to see support to the upside at the 4900 level, and that's just how it works. Dealers buy dips, sell rips in positive gamma, and we are in positive gamma right now. Now, something to note, dealer delta continues to be negative, which is positive for the market as a whole. Yeah, look what happens when we went into positive dealer delta. We came down and then we went into negative dealer delta. We sort of had this remarkable rally in the last 2 weeks. Looking at charts as a whole, and again, the S&P 500, we sort of like gapped up to the 4900 area, this core gamma resistance, and sold off the whole right there. Again, the chart does look healthy. That candle looks pretty ugly as a whole, but a lot of it had to do with the bond auctions. Now, looking at the 5-minute chart, and you could see right here, the 4900 level, this is where we met resistance. Now, this happens to be the core gamma resistance, but it also happens to be at the time when the bond auction didn't go so well and we sold off. So there was a bit of confluence with everything right there, and that made for a good short. Something really interesting I just want to bring to you guys' attention. This is super interesting. Fewer eyeballs means less efficiency, more alpha. The number of analysts covering the average stock has dropped from the peak in 1989 from 21 analysts to 17 today. The number of active large cap mutual funds dropped 40% from 2014 today. So you would think that as we've had this huge bull market that we would actually have more analysts reviewing stocks, but simply not the case. Now, looking at the equal weight, and you guys know my stance, as long as we're above 155, I'm constructively bullish. This price action is not making me feel warm inside, especially as we had a big rejection right here. And what this looks like is a lower low compared to this, and then actually making a higher low. So we're sort of downtrending, but what would really need to happen now is that we need to break below this 153 level and probably put a daily close there, maybe even a weekly close below this level right here. But until then, constructively bullish above 155 in the S&P 500. Now, looking at the US dollar, we are seeing a massive amount of rejection right here. I think a lot of people don't want the dollar higher than the central banks as a whole, countries as a whole, and that's why we're seeing weakness in the dollar. And to be honest, we really do need to see the dollar go lower. It's really going to help corporate earnings. So hopefully we are seeing resistance. This candle did scare me a bit, but all in all, it's looking like we are seeing resistance in the dollar right there. Now, looking at semiconductors, not much to say, looking very strong. This is probably the ugliest candle I've seen. It's a green candle, but I mean, that's a strong rejection, and it's not something we've actually seen in a very long while, where it's a green candle and we've seen a strong rejection wick on the top. Just something to note there. Now, looking at small caps, and that's a higher low, and we're making, like, I wouldn't say a lower low because that would be the real lower low, but you know, we did break the low right there after we sort of did rally, and we did close this gap and move down lower. So, and we haven't been able to break this high, so small caps need to sort of just like build a base of support and then choose which way they're gonna go. Now, looking at PayPal, and we're sort of still bouncing over this 200 moving day, and we're in this trend channel. As you can see, this uptrend is probably going to be a line of support if we do go ahead and break this 200 moving day. But later today, or early tomorrow at 9:30 a.m. is the innovation day, the first look for PayPal. We're going to see what Alex and the team have in store for PayPal. But for some reason, something inside me, I sort of have been getting the feeling that it's going to be a nothing burger, and we're probably going to go back down to this 58 level, maybe shake out a few of these weaker longs. But all in all, I do think the stock is severely undervalued. I mean, we're looking at a stock that is like a 10% free cash flow yield, trades on like 14 to 15% return on invested capital. Its cost of equity is very close to 10%, and it's expected to grow earnings over the next 3 years at 15%. And that's EPS. So, you know, there's a lot of tailwinds in the stock as long as they can maybe expand margins and keep transaction volumes where they are. I do see potential upside for PayPal, and we could definitely see very close to the mid 90s, you know, 94, 95 area for PayPal in my personal opinion. But it's all going to come down to execution in 2024 and what their earnings report looks like. Earnings is on the 2nd of February. Now, looking at Tesla, this is where they were pre-market. Rough situation for Tesla, really was. But these were some trend lines I was looking at, it's broken below this, and maybe we go to this black line right here. This is probably the last stand before we go ahead and maybe hit this 150 level, and below that, you know, we're looking at like 100. But yeah, bulls need to make a stand right here for Tesla. But the earnings call was not good, guys. Go listen back to the earnings call. Not constructive in my personal opinion. Service now super strong, gapped up, sold on earnings though, by the way. I think it beat on everywhere, but the street was expecting more. ASML, this is the weekly chart, up 8.85% for the day. Very strong, broken above this key level, and everybody's looking at 2025 because they said significant growth in 2025 but unchanged guidance for 2024. All in all, they did beat on earnings, beat on revenues, beat on margins, beats everywhere. But 2024 is going to look very similar in terms of earnings for this full calendar year. Looking at SAP, big day for SAP, up 8%. I mean, we gapped up, market sold off, but then we continued higher, and absolutely crazy price action from SAP. This is a German tech company, and I used to work for an accounting firm. We use their systems a lot, very efficient systems, but I think they're also into cloud right now. Their cloud revenue skyrocketed, and I think that's why we saw price action we did, and it's probably going to go higher. It'll probably go attack this 168 level, and I do believe this is very close to all-time highs. Don't quote me though. Looking at Visa, this is such linear returns, especially from October, like almost not a bump in the road at all. This is where we stand right now, up 0.14%. The reason I put Visa here is they're reporting earnings tomorrow, and if history's anything to go by, they're going to report earnings in line, a ton of revenue, 53% net margin, right? So they make like $100 billion, and they have $53 billion in the bank at the end of it. Huge, like, return on equity is just wild. Such a high quality company. Everybody should own Visa. I own Visa. The company with the best financials I've ever seen, ever. Not in terms of size, but just in terms of quality of margins and operating income and how efficient they are as a company. Now guys, tomorrow, big day of data. We have durable goods, initial jobless claims, GDP. This is the big one. This is what everybody wants. So what are we expecting in the GDP print? Are we expecting in the preliminary GDP print annualized? We're expecting 2%, but BofA reckons we're going to get 1.5%. I think Goldman Sachs thinks we're going to get 2.2%, and I think LSEG said 0.7. So huge range of discrepancy here, but let's aim for the 2% mark. GDP now is at 2.5% at the moment. So, but we're also getting new home sales for the week on Thursday, and then we're getting Visa tomorrow, and we're getting Intel earnings as well. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys, like this video, and leave a comment. And I'm going to leave you with a quote today. Don't hate the player, don't hate the game. Just play the game and play to win.